Good afternoon. Can y'all hear me okay? My name is Karen Anderson, and I'm the Managing Director of the Social Finance Institute. It is my pleasure to welcome you all, and we want to extend our deepest thanks to our colleagues at the McCourt School for hosting today's event. Thank you also to our panelists for what I'm sure is going to be a very dynamic and timely conversation. The Social Finance Institute is part of the national nonprofit Social Finance. We strive to fill gaps in knowledge around a range of innovative financing models designed to improve economic mobility. One of the ways we do this is through applied research, often partnering with academic leaders in the field. We are delighted today to release a new applied research paper. Hopefully you picked up a copy on your way in. Lessons Learned, Financing Workforce Education and Training Through Outcomes-Based Repayments by Professor Harry Holzer and David Socolow, who is the head of policy at the Social Finance Institute. Harry gets a better intro in just a second. At the Institute, we have made it a priority to study outcomes-based models for funding workforce training, drawing on the expertise of the social finance leadership in this practice over the past decade. When we began thinking about this paper, Professor Holzer very quickly came to mind as a natural partner. As you'll see in his bio, if you go to your agenda, there's a QR code. You can take a look at all of the bios. He is the John Lafarge Jr., S.J. Professor of Public Policy at Georgetown's McCourt School of Public Policy, a non-resident senior fellow at Brookings, and is a former chief economist at the U.S. Department of Labor, among many other credentials and titles. Harry is one of the country's leading experts on labor markets, workforce policy, and economic opportunity, and his work has long focused on the challenges facing disadvantaged workers, and the policies and practices that can help expand access to good jobs. The combination of Professor Holzer's academic rigor, his policy experience, and deep knowledge of workforce issues made him an ideal collaborator for this project, which asks a practical and timely question about how we finance short-term career-aligned training in ways that better serve workers, employers, and the broader economy. Thank you all for joining us here today, and please join me in welcoming Professor Holzer for his opening presentation. Thank you.
Thank you, Karen, for those very nice remarks. Just want to start by thanking a few folks. My terrific co-author, David Socolow, who knew vastly more about all this when we started writing, still probably does today, but we ended up being a good team, I think, and Karen and everybody else at the Social Finance Institute for their support. Everyone who agreed to be on the panel today, welcome. Thank you all for helping us out. The wonderful events team here at McCourt School, Jack and Crystal and everyone else who did a great job, and then all of you for coming today. So I hope we will make it worth your while. So David and I wrote this paper on lessons that we've learned so far from financing education and training with outcome-based repayments. This has been an area where there hasn't been an enormous amount of really rigorous analysis and evaluation, but a lot of really useful experimenting, trying things out, so we can learn some things about what we know and what we don't know, and there's a lot more to learn, as we found out looking at this literature. But let me start with the question of, so why do we even need any of this? Why do we need new models of financing education and training? As an economist, of course, I start with the human capital model that I think everybody has learned, if you ever took a labor econ class. The basic idea is that both workers and employers make investments to try to raise the productivity and the earnings of their workers, as they should do. But we also know from this literature, economists have known for a long time, that the amount of investment made and the quality of investments can often be very limited by a set of what we call market failures, public good aspects of training, capital market problems, et cetera, as well as inequities that might mean that the lowest income workers, people of color, women, excluded groups, traditionally marginalized groups, might be particularly disadvantaged in this world. All of which leads us to the notion that, okay, there's got to be some public funding in this area, and that's not a very controversial idea. But in fact, when you get to education and training for adults, there's one area where America is reasonably generous. That's through Title IV of the Higher Education Act, Pell Grants and federal loans for people going to accredited colleges. Outside of that, there's sometimes shockingly little that we provide in America for other forms of training. And even within those accredited institutions, we've been very uneven in terms of what counts for Title IV and what doesn't. America's recently tried to change that through what a lot of people call workforce Pell. That was an effort in the One Big Beautiful Tax Bill to provide more Pell assistance for short certificate programs and not for credit. I think there's a widespread point of view that might have potential over time, but in the short term, it might be tough to squeeze a lot of juice out of that orange. There's other things available. There's employer-provided tuition, and Section 127 of the IRS code means you can get a worker can get over $5,000 of employer assistance without paying any tax for it. And there's of course, other parts of the system too. But there's big holes. And we very much want to come up with new modes of financing, education, and training that serve as complements to all that's there right now, not substitutes. And of course, exactly how to do that, we're still thinking through, and we look forward to your suggestions on that. But with all that as introduction, what are the upsides and the downsides of these outcome-based repayment models? So just to be clear on what I'm talking about, outcome-based repayment model can be anywhere where a third party, the third party can be public or private, it can be for-profit or non-profit, a third party puts up the upfront money for educating and training workers or for employers, and then they have an obligation to pay back that money, but only if certain benchmarks of progress have been made, higher earnings for workers, et cetera. So the upsides of that are many. First of all, it should provide a good deal more funding, because especially from the private sector, especially from for-profit as well as not-for-profit, it should help reduce the risks on human capital payments. And all investments are risky in this world, but especially if you're looking at workers or their employers trying to invest in the future, not always knowing if the kind of education and training they get is going to pan out for them. You'd like to reduce those risks if possible. And it also helps to align incentives with outcomes, because lots of players in this world will have incentives to make sure that the training is effective and high quality. Otherwise, they don't get their finances back. So there's those positive aspects. But at the same time, we know there's downside. First of all, there's quite major obligations on the borrowers who may have to repay these funds. And in many cases, the terms of the deals are hard to understand and a little opaque. There have been predatory lenders in this world, and we need to rein them in. Anytime you do education and training, there are some groups with potentially weak outcomes for some of the borrowers. And the more of that you have, the more it maybe undercuts the success of the whole system in doing this stuff. And then finally, especially economists and other public policy analysts know that anytime you try to do sort of some kind of performance-based model, you might get adverse incentives for gaming. For instance, you might encourage the providers to only let the most successful people to make their numbers look good. Most successful people into their institutions. So, and we strongly believe that both the upsides and the downsides, the magnitudes of the upsides and the downsides are going to differ for different groups of workers, different employers, different industries, right? So we start with the assumption that one size doesn't fit all, but everything we've learned certainly reinforces that view, right? There's likely to be different market segments. There's likely to be different funders. Some things are going to work differently in one segment or the other segment. And we have to prepare for the possibility that there might be some groups of workers, lower skill, lower wage workers, for whom this might not even be a model at all that works. And maybe we need other things for those folks. With that all, again, as kind of thinking about this, we did a landscape analysis. There are, at least by one recent count, well over 300 programs of this nature around the country. We did a sort of closer look at a little over 30 of them. And you do see this wide range of program and participant characteristics. First of all, there's this difference between ISAs, income share agreements, and OBLs, outcome-based loans, with the main difference being, an outcome-based loan is for the repayment is for a fixed amount of money, like any loan, right? You have a balance you need to pay off, whereas the ISAs, it's more for a fixed percentage of your income that the funder might try to get back from you. So, and the world, they seem to be tilting more towards OBLs over time, but it was clear that some funders prefer one model or the other. If you look at those funders and then you look at the program operators, there are both private and public funders. Some of them are for-profit, some not for-profit. Among the private funders are both investors looking for a full rate of return that they're used to from the market. Some investors who are impact investors, willing to live with a smaller rate of return if they see some kinds of social good being done, or the philanthropies, looking for less return at all. And of course, the public sector. But the public sector has also gotten more interested in pay-it-forward models where they're counting on some of that money to come back so that they will then have funds built in for a next round of recipients. And again, the program operators and providers come from all of these different segments: for-profit, not-for-profit, the higher ed world, other training providers, et cetera. The average terms that we see when we do a scan of all these different programs, on average, there's a minimum threshold of earnings of usually in the range of $40,000 to $50,000 before the obligation of repayment kicks in. $40,000 on the worker's earnings before either the employer or the worker has to start paying back. And by the way, some of us think, and Dave and I have talked a lot about this, if you're talking about really low-wage workers, that might not be an appropriate threshold either, right? If someone's earning 20 today, the odds of them getting up to 40 and 50, it's not impossible, but the odds will be longer. Maybe the appropriate threshold for them is a percent improvement, percent increase, what economists call value added, rather than a fixed level. Just one more thing to think about. And then there's two characteristics of some of these programs that we regard as particularly promising and certainly deserving of more experimentation and more study. The idea of employer repayment, that if employers see themselves as getting a real benefit from these programs, if they're having a hard time finding and retaining really well-skilled employees for what they need, they might have more incentive to participate in this. So, we need to figure out when that's a strong incentive for them and when those standards work well. And of course, the other thing is in terms of the workers themselves, we all know this, tuition is not enough. People have needs. Adults often need to support families. They need stipends. They need provision for living expenses. What are that whole category of wraparound supports that makes this stuff work better? There's one of what we would call a more serious evaluation from MDRC, the big evaluation house in New York. They were studying a set of 4 programs that were called career impact bonds, actually developed and financed by social finance. The study's not an impact study. There's no randomized trials. It's more of an implementation study with a lot of important descriptive results. Of the 4 programs, one focused heavily on people with bachelor degrees, which could still be an important segment of this market. The other 3 did not. You see all of the evidence of all the upsides and the downsides that I noted earlier on in this study. On the upsides, the workers do feel like their access to more training and more funding for training, that access improved because of these funds. And you clearly saw the downside, that the fraction of them who should be repaying, less than half of those folks were repaying. Many people were not that familiar with the details of their agreements. So, plenty of room for hope and for concern. We did find these 2 bright spots. One program, a piece of it, involved funds to employers, with employers having the obligation to repay, and the one program that served people with BAs. In both those cases, they had higher rates of compliance with the rules and higher rates of success, which is interesting. It's not definitive, but something I think important to note. And everything else we saw was consistent. We did a whole range of qualitative interviews, actually with some of you in the room right now. And again, we thank you for helping us out. But what we heard from all of you was very consistent with what we saw in this evaluation, and we need to keep all those lessons in mind. So what are the sort of sensible next steps? Experiment and evaluate with different kinds of models aimed at different segments of that worker market or employer market, with different funders who have different needs, expecting different kinds of returns. Ultimately, all to answer the question, and the evaluation, of course, will need to be rigorous, RCTs when possible, or something experimental. But trying to answer the questions of what works and for whom. And the answer of what works will presumably not be the same for everybody, for all funders or all workers or employers. And ultimately, we're looking for what is cost effective and actually scalable from a policy point of view, because that's the only way you really get to have important impacts on outcomes. Both at the end of the paper and also in the little brief that some of you picked up, we list a whole range of takeaways for key stakeholders, a lot of which involve some of the things I've already said, but also some specific things for those different stakeholders. For instance, public funders, the state and local government, they have a strong responsibility to make sure that we get the right data to measure outcomes and evaluate impacts, and to try to encourage more of those kinds of studies. The same thing for the philanthropic funders. They need to insist on good evaluation studies. And then, as we said, the funders, the investors, and the program operators, and the industry and employer groups, hoping that they will try some of the program characteristics that we were excited about, the employer-based repayment, some of the wraparound supports, but again, where appropriate, given the characteristics of the workers and what the employers need. So thanks very much for joining us today. We really look forward to learning from all of you as we discuss this stuff. There is a lot more to be learned, and we look forward to your suggestions for how to learn all that. But anyway, thank you very much.
Great. Well, thank you all for being here for this, what should be, I think, a really fascinating conversation. I'm Rachel Lipson. I'm a research fellow at the Harvard Kennedy School, also affiliated with the Aspen Economic Strategy Group here in DC, as well as Brookings Metro. Honored to be the moderator for today's conversation, and hopefully to kickstart an important conversation that this paper has really released for all of us. I know I found it incredibly useful gap, filling an incredibly important gap in the literature right now, just around seeing sort of the landscape and all of these programs in one place, and I think can hopefully start off an important set of lessons on where do we go from here. So before we get started, let me just take my moderator's privileges to introduce the rest of our glorious panel here today. You already met Harry. Next to Harry, we have Harry's co-author, David Socolow, who's the head of policy at the Social Finance Institute, where he leads initiatives in collaboration with policymakers, researchers, and peer learning communities to build knowledge about outcomes-based policies. He spent over 30 years in government and the private sector. Most recently, he led New Jersey's Higher Education Student Assistance Authority, where he created the state's first tuition-free college program and also expanded the gamut of different types of financing options for job seekers. He also serves as New Jersey's labor commissioner. Next to David, we have Ethan Pollack, who's a senior director in the policy and advocacy practice at Jobs for the Future, where he explores approaches to education financing, including income share agreements, outcome-based loans, and other innovative approaches. He's worked prior to JFF at the Aspen Institute, the Pew Charitable Trust, the National Commission on Fiscal Responsibility and Reform, the Economic Policy Institute, and the U.S. Office of Management and Budget. Welcome, Ethan. And last but not least, to my right here, we have Jason Sisko, who's a senior vice president at the U.S. Chamber of Commerce. His picture has cut off his bio here, but Jason leads. Many of you in the room, I think, already know Jason. He's a critical part of the Chamber's work, mobilizing employers around the country around talent finance, as well as a variety of other critical workforce development policy issues. So, welcome to my panelists. To kick us off, Harry, I think you referenced a little bit in your intro remarks, but I am kind of curious why now around this paper? In my view, I do think this is a particularly interesting moment for exploring different approaches to unlock more capital for workforce development and education and training. I mean, I'm thinking about this moment of potential displacement around AI, a weakening economy. One might also look at the US fiscal picture and note that we're not in a circumstance where there may be tons of additional federal money available in the traditional form, but I'm kind of curious how you see the lay of the land. In the time that you've been looking at this space, are there reasons why this is a particularly apt moment to consider other types of financing?
I think so, and it's exactly for the reasons you laid out, so I'm just going to piggyback on the things you said. So first of all, we are in a world where the amount of debt that students are carrying has gone way up over time, sometimes for good reasons, sometimes for not. Many of the forms of training have gotten more expensive. There are questions about the return to different kinds, and especially for people for whom might be a riskier investment. So all those things have been there for a while, but maybe picking up steam and picking up importance as context. And then of the things Rachel correctly said, I would say one in terms of the demand or the need for more training and newer financing training, and one on the supply of funds for that. AI is likely, as we all know, to shake up the labor market and to really shake up what skills employers expect workers and what skills they're actually going to be willing to pay for. We don't know what form that's going to take, but it will likely raise the need for reskilling and upskilling of workers who are on the verge of getting displaced by AI, who need to pick up new tasks. So in the terms of the demand for more training, I think AI will likely play an important role. But then on the supply of providing this new training, the funding picture, certainly at the federal level, is bleak. Everything at the federal level in terms of fiscal situation. Just not going to be big pots of money there to invest in new kinds of training. So the need to broaden the finances in support of education and training, to try to draw on the private sector, which has to be critically important here, and also to provide new sources of funding in different contexts for workers who will be impacted by AI. I think all of those things mean it's a great moment for this.
David, I'm curious if you agree. I mean, you've sat in the seat of being a state policymaker, thinking about these issues for many years. Do you feel like the moment right now is different? And if so, in what ways has it changed?
Yeah, I think it is different. I think there is a greater focus on shorter term and more directly short-term training that gets people directly to a job. There's perhaps a bit of a backlash against a college for all messaging that was around for a couple of decades. And so there's more interest in experimentation. And so you have one experiment at the national level, which piggybacks on what a lot of states were already doing in this field with the new workforce Pell, new funding stream for certain kinds of short-term training. And I think that it just points out greater appetite for workforce development, maybe not with new funding, as Harry just said, but certainly with new attention. And so what this offers is a chance to look for blended ways to finance that.
Ethan, you've been at the core of a lot of the conversations on this topic for over a decade. What do you think has shifted or changed over time? Like, what is different now than if we were having this conversation here at McCourt 10 years ago?
I think I agree with a lot of the comments that have been made, and in particular, that we for a long time had a very degree-based, kind of to the exclusion of everything else in investment strategy. And so for a very long time, we've been underinvesting in workforce training. Our investments in WIO, which the federal workforce collection and programs, has declined precipitously over the last 2 decades. We now invest as a country about 1/10 of 1% of our GDP, which is the lower than every other industrialized country except for Mexico. And so, like, we've been underinvesting for a long time. I think that what's changed is that we are now recognizing that, and we are now realizing that that is actually a problem. But and I think also then a lot of the budget constraints that are, I think we are feeling more tightly, and I think we are going to for the next couple years in particular, really force us to think creatively about how do we stretch these budget resources. And then also the emergence of AI, but not just AI. Also, there is a freeze in the labor market, which may be attributed to AI, maybe not, but it appears that young workers in particular are really suffering and unable to get jobs. And many of them, in particular those without college degrees, have just simply dropped out of the labor force. And so, if that is the case, those early, kind of first rungs on the career ladder are so important for career development. And so that is also an area where workforce training can really come in and help provide a lot of that development, so that they are not just simply left without any type of way to then continue or advance their career.
So Jason, I mean, all of your co-panelists just referenced the uncertainty, to say the least, about additional public funding. It seems that from the paper lays out a compelling case for at least the impact of employers having more skin in the game here and doing more. You spend a lot of your time talking to companies. Why do you think we haven't seen as much interest to date yet in these types of models? And what do you think would be the key levers to getting more private sector entities interested more in investing, maybe in investing training more broadly, but then specifically constraints around overcoming constraints for outcomes-based financing and interest there?
Thank you, Rachel. I'm actually an optimist in this space, and I would agree with where Ethan was going. It's something I've been saying for some time, and I usually use it as something provocative to kind of get people's attention in the room, but I've long said we don't have a workforce development system. We never really did have one. And if you just follow the money, there's your answer. And so when you talk about like resources getting tight, I'm like, it doesn't affect us. I mean, in the workforce world, it's always been tight. It can only go up. So I say that a little tongue in cheek, but I'm excited that this is actually creating an opportunity to do exactly what Ethan was saying, which is let's look to this space that's been historically underfunded and let's create something new. So I think it's ripe for innovation. I think the only way is up, and I think employers are going to play a sizable role in that future. So I do see increasing interest in employer financing. One myth I would like to dispel is people think employers don't pay. They pay more than you think. If you were to add up all of the formal and informal training expenses on that side of the ledger, that's a $500 billion economy. If you were to look at what they're reimbursing in terms of Section 127 of the tax code, which Harry referenced earlier, that rivals Pell Grants today. So businesses are putting skin in the game. It's a different story than when we look back to like the 1940s and 50s compared to where we are, but the money is still flowing. Now, you could argue it's inefficiently flowing, and I would certainly make that case, but there's money there. So a lot of upside potential, and I think there is appetite for some of these outcomes-based programs, including using Section 127, the new authority in it to repay down, or it's not that new, but newer authority to kind of pay down those obligations. And some of that's more just like we need to educate them. So we can work on that. We can partner with you to get in front of 3 million firms to let them know about these opportunities. So some of this is just going to take some time, and it's going to take education and capacity building. But just to give you a sense of kind of one big picture idea that's coming out of the private sector, we, as part of our talent finance initiative that we launched, and Ethan was a part of that, David, others, one of the big ideas that came out was this concept of a skill savings account. And it was modeled after an HSA, but for skills. So instead of doing an investment vehicle that's in kind of the old finance paradigm where we're just trying to like invest dollars over long periods of time to offset the rising cost of higher ed, this is more dynamic upskilling. If I had $500 right now from my employer in a debit account, what could I do with it? If I let that build to $2,500 and I lost my job, what could I do with it? If I had to take it from employer to employer and build it up, what would I do with that? So we actually have a draft bill being prepared right now Whereas we've looked at this, if we treat it under the same terms and conditions as Section 127, and we try to double uptake what we've seen with HSAs, we think we could hit a third of the workforce and we could generate over $100 billion in upskilling resources. And those are employer contributions that just are not taxed. So where I think you're going to see a lot of innovation isn't going to be large appropriations. And that's kind of what I'm hearing from this panel of like, that's how we think of government. It's big appropriations. I think it's going to be smarter tax policy that's going to incent businesses and individuals to treat their money differently. And I think that's an unlock with Section 127 where, it's been pretty limited use. You have less than half of employers offer anything at all in terms of an education plan. And if they do, so they're investing on the accounting side. If you look at the accounting side of the ledger, they're investing in training. But when it comes to employee education benefits, you have fewer than half of companies, nearly no small to mid-sized companies. And if they are offering, I'm not sure if anyone knows the percent of workers that take advantage of it. It's about 2%. And yet, about $30 billion. So tweak the policy, and let's get 3, 4, 5x that, and that's a start.
Fascinating, yeah. I'm curious, I'll throw this both to Harry and David. Does Jason's comments resonate with what you heard conducting interviews as part of the paper? What did you hear, and any interesting tidbits that you would share or highlights from the paper around what types of changes would make employers more interested in investing through these types of vehicles, or more broadly in other ways of financing training?
I think that what we heard is very consistent with what Jason had just said. And it just makes a lot of sense given the context we're in with certainly the federal government's finances and limitations of getting new resources, that they move in that direction. And Jason's described something that relies heavily on employers. So, and I've been thinking about and looking at employer active programs for a while, both sectoral training, where the training is really targeted towards employer needs, also work-based learning, apprenticeship, all those things. One thing that always stands out to me is that, so first of all, some employers need a lot more of this than others. The employers who are facing a set of skill needs that they're having trouble meeting, skilled workers that they're having trouble both attracting and retaining, they're the ones most interested in these kinds of arrangements, broadly defined. But they feel very strongly, they don't want to waste their time and their money on workers who will not work out successfully. So you really see that in the best of those sectoral training programs. They do screen out all kinds of workers, and the providers are only going to maintain their reputations if they send the employers what they want. I think something like that is going to be true here as well. I think the outcome-based repayment dimension of it certainly reduces the risks for employers, right? Because they're not on the hook if the workers they are sent don't work out. But they don't want to invest the time and the effort with workers who aren't going to do well. So we really have to think, I think Jason's broadly right, but going back to this question of exactly what is going to work and exactly for whom, with the idea that it's not going to be one size fit all, and it'll be up to all of us to help figure out exactly what works for different groups and for different categories of employers.
Yeah, I agree entirely with that. I think that the sectoral approach of job training generally is doubly relevant for these outcomes-based repayments. We shouldn't necessarily be talking about employers. We should be talking about employers in a given industry with a specific occupational niche. That's where you start to find the sweet spot, where these repayments make sense. There's an ROI for the employer because there's a recruitment or retention problem that they're trying to solve. There are as Jason has said, there are lots of different ways that employers are investing. This risk mitigation model is a way to invest when, the ROI is not quite as certain. This actually could help on the margins where I'm not sure what I'm going to get. This isn't necessarily a proven training program. I'll partner with it with this kind of downside risk protection. I'm not going to have to pay back if it doesn't work out, if you send me employees that don't raise my enterprise's productivity or value or for whatever reason, disappear, go work for my competitor, which is the other major risk that employers always raise with job training. I'm training someone else's employees with my money. And so that's what this offers, in addition to all the other ways that we can incentivize employers to invest, is that risk protection.
Can I add something really quick? Because we often think of, like, when we say employers, it's, we speak of them as like a monolith, but when you get down to the finance instrument, it's each company kind of out there by themselves making these decisions. And that makes sense. One of the things that we've been working on, the Chamber Foundation, is we've built this national network, it's now going global, of kind of talent supply chains. And they're operated by a variety of intermediaries, but many of them are state or local chambers of commerce. And we've kind of given them the capacity to work with groups of employers, in many cases on a sector-by-sector basis, but they essentially pool the demand and then negotiate the talent pipelines. So they're out there designating whether it's a community college, a high school, another training provider, but here are the preferred providers for these positions. We know how many we need, where we need them, when we need them, and here's all the skill and credentialing requirements. They've essentially kind of bought down the risk because they can tell you this is how many people we're getting from these programs and this is the jobs that are going to land. And what I've long tried to get them to do is now take it a little further and go get them a better loan product because you bought down the risk. So I think there's more we could do there. So it's not just every company out for themselves, but if companies work together, that could unlock a different kind of finance dynamic that can make it more affordable. But I also think they could become operators of some of these funds or solutions. I haven't quite figured out how to do it, but would love to continue to noodle that one, because if you can build in their capacity where this now becomes outcomes-based financing as a member service, I think there's a lot of potential there.
Fascinating. Ethan, I mean, you've been involved and you've seen a lot of these programs over the years, maybe been part of playing a role in some of them. Are there any particular features that you think are particularly well suited to a company or an employer being the payer, or that have made it, that will increase the appetite for employers to be offering them as one of their core means of financing training?
Certainly, and I think David really hit it in his comments around kind of de-risking it, right? So that there is uncertain ROI, and also there's concerns around poaching, and so this is a model that it doesn't solve those, but it does mitigate some of those concerns. It addresses those concerns in a really important way, and I think that that's like a really good approach to this problem. In a lot of these conversations in kind of workforce policy spaces, oftentimes we lament how there's not enough training and investment, and people say, well, employers should do more. And Jason, you're right, they already do a lot, and that is not it's just not part of like the broader system. But it is also the case that employers that there is very strong both theoretical and empirical evidence that there is a market failure, as Harry mentioned in his presentation, that there are structural reasons why employers do not invest as much as would be both socially and economically optimal. And for one example, along with a lot of the others that have been mentioned here, is also the accounting treatment, right? So if an employer is investing in a factory, that asset goes on their books. It doesn't look like it's just money that went out the door. They bought something, right? They bought the factory. They own the factory now. And that shows up on their books. For investment in human capital, that shows up just as like an overhead. That shows up just as an expense. There is no asset that you are purchasing there, right? It is really hard for a company to signal then to capital markets, hey, we invested in these people are now more productive, and please recognize that as part of our as part of our kind of net wealth and productive capital stack. So like there's many reasons why employers don't invest as much as they could, as much as would be economically optimal, even though they do a lot. And so we need to think of things like this model on how do we actually address those those barriers in a really clear-eyed way, rather than simply kind of wishing away and just being like, why don't employers do more? Because that will never get us there. We need to actually be thinking about why don't they and how we can address that.
Yeah, I like that a lot. And in the spirit of being clear-eyed, let's talk about some of the other kind of barriers to scale. I'd say in a lot of ways the paper is is telling the story of a collection of pilots. Is that fair?
Yeah.
We haven't seen this type of financing scaled in any significant way in a U.S. state or particular context.
Not yet.
Not yet. I know it's part of why we're all here today. Curious, I guess let's start with you guys, Harry and David, and then we'll move on to the rest of the panel. To me, one of the biggest barriers that comes through in the paper and from my own work in this space is kind of the data infrastructure that's required to actually accurately be able to know whether someone has met the performance metrics, and then also to operationalize repayment and remove some of the compliance burden. Do you agree that data is one of the biggest barriers to scale? And what do you think would be required if we were going to overcome that hurdle?
Yeah, I mean, from an operational standpoint, having a repayment mechanism built in, creates the obligation for data reporting. When people are not going to not have an obligation to pay if they don't have an income above a certain threshold, they're going to have an incentive to tell you what their income is. They're going to send you their pay stubs or otherwise, or if the employer is the payer, they know their payroll. They can easily document what they paid someone, and so you have that data. A lot of these models have experimented with different ways of enforcing that obligation. I mean, what you are running is something that is a form of a loan, and so you have a collections mechanism, and collections is inherently difficult. And the federal student loan program has issues with collection, and so do these models as well. And so the goal should be to make that as easy as possible. It's one other reason, in addition to skin in the game and solving employers' problems, it's one very operational and administrative reason why it's great to have the employers be the repayer on behalf of the workers they hire and retain, because that does simplify a lot of the administrative data collection issues.
All of that is clearly true. I guess anytime I dive into this area a little bit, just struck with the amazing level of heterogeneity, both on the worker and on the employer side. I mean, the workers, from the most skilled to the least skilled, all of whom could, in many cases, use upskilling, but their ability to participate in a program like this, to meet the obligations, even to understand the terms, just varies enormously and just makes it hard to. And same for the employers. There's no question some employers, sometimes in this world we talk about high road employers and low road employers. Well, low road employers aren't going to be interested particularly. They're looking to contract out any skill needs and things like that. So we've already said, one size is not going to fit all, but then you get to then what's possible to scale, because you need scaling to have any of these things have any kind of impact on the labor market. How can you scale? Now, having data that work and that ultimately get standardized will certainly help in the scaling process, but allowing for the sort of dramatic heterogeneity of needs and abilities when you think about scaling, I think will be challenging.
Jason, I want to come back to you in a second to talk more about data, but first, Ethan, I'm curious, are there other kind of challenges or barriers to scale that you would add that you've seen from your work over the years that haven't been mentioned yet by David or Harry?
Yeah, well, two things. So one is, I think the servicing that David did mention, I think it's just good to double down on that in particular, just that I think that there's creative ways of doing that as well.
When you say servicing, meaning the operation, like how to operate?
Yeah, how to be collecting the repayments, and doing that in a way that feels very, both that it is creating financial sustainability for the for the system as a whole, yet at the same time is very student-centered, right? Because there's in servicing and collections, there's a lot of very student-uncentered ways to do that. The other issue, the other area where I think that there are some obstacles is actually around, and we're in a policy school right now, so I'm going to talk a little about policy. both at the federal and state level, we have consumer credit, regulatory treatment of loans and loan products like this. They were really designed for fixed payment consumer credit loans, and they apply poorly, I would say, and inconsistently to this type of unique outcomes-based financing product. And so that's one area. I'll give it one example. In many states, there's something called, as part of the Uniform Credit Code, called substantial equal payments provision. So this requires that for any type of loan, that the payments on a month-to-month basis are not varying more than a certain percentage. And the idea is that it's trying to protect consumers from balloon payments, right, where you get that teaser rate, and then all of a sudden it jacks up and it's really unaffordable. But here, obviously, the whole point is that the payments vary. They vary with income. That it on a very tight correlation with something like an income share agreement, but even with an outcomes-based loan, whether you are paying or not depends on your earnings. So certainly, if you are no longer employed, your payment should vary from month to month. It should go down. Yet at the same time, we actually have regulations on the books that can actually prevent that from happening, or can make that more difficult to design a credit product that actually has those student-centered features. So there is regulatory reform that needs to happen both at the federal and state level. And Illinois has passed a really good legislation over the summer, passed unanimously, and Governor Pritzker signed it to law this past summer, that creates a more thoughtful regulatory regime, in particular for income share agreements. But there's a lot of efforts then also on the federal level to expand that towards the broader outcomes-based financing tools, which includes outcomes-based loans again, and just really being thoughtful about how do we protect students and consumers while at the same time designing a regulatory treatment that is uniquely customized for these types of products.
Fascinating. Well, I said I would come back to you to talk about data, Jason. I know this is a passion that you and I share. I think in some ways we can think about this space of outcomes-based finance of data in this space as like, it's just one piece or symptom of a larger systemic issue. One that maybe I would define is that at least in higher ed, in traditional higher ed, we've made some progress with the college scorecard around being able to have systematic data that we can trust around what programs and what outcomes they've led to. In the workforce training space, we don't have that. We don't have that today, and that's a kind of root problem that makes operationalizing models and products like these very challenging if there's not easy ways to know exactly how much someone has made after they've completed X program. Can you help the audience kind of like think through the nature of that challenge today and what you see as some of the solutions that could help us make progress in overcoming that hurdle?
Yeah, Rachel, you're right. This is a much larger issue for the country. This is finance is just but a symptom of it. And again, I'm an optimist. I think there's something that could be done here. But much like I said that we don't have a workforce system, just follow the money. Looking at our labor market information, it's bad, and it's really bad. And we tend to just gloss over all the warts and the gaps and the holes, and it's only going to get worse. And as we were preparing for this panel, one thing I brought up is the funny thing that's going to happen. I think that's going to change the game when it comes to data used for different finance products and things like that. It's the Medicaid program. Because in the One Big Beautiful Bill, there are going to be new verification requirements that come into play starting next year that states are going to have to react to keep people in programs to verify their eligibility, or they will be sanctioned. And no state right now has the data infrastructure to do it. But should they make a few smart plays here and move towards standardizing the data that's collected about employment and income and modernizing how it is shared principally with state and federal government, this could be the game changer we've been looking for. So think of it this way. We've been bootstrapping like unemployment insurance systems for a long time to try to tell us what's going on. And we use it in the education system, we use it in the workforce system, we use it in a lot of other systems. It was never intended for those purposes. It's missing critical information. You have 53 systems of collection that do not share a data model or definition across them. And yet we are making high stakes decisions across the board at the state and federal level using bad data all the time. I even say bring it to the college scorecard. It's like a really skewed view of what's going on in terms of education outcomes around programs and credentials. So now bringing it back, if we leverage this crisis moment to say, if we want Medicaid and SNAP to keep working and we want UI to have less fraud and all of that stuff, now's the time to modernize this data. And once it's done, let Medicaid pay for it, and then let finance benefit from it. So you would actually have more timely data about employment outcomes, around income, more standardized reporting and definitions around those things. And you'll actually be able to know when somebody is potentially eligible for a collection. Or more importantly, if you're trying to look, kind of going back to the beginning presentation that Harry gave, if you're trying to figure out, well, how do we know what's working? Well, we need good data on that. You need it fast, so you're doubling down on what's working and you're getting out of the way of, or getting out of the business of what's not. So normally I would say this is a massive kind of barrier that is always just going to be hanging around the neck of finance innovation. But again, I'm an optimist. I think this is going to be solved, and you're going to see some solutions come into play in the very near future, and we're going to fix this. And I think it's going to give the financial services industry, broadly defined, the information they need to be more effective. So I'm excited about it. I do think you're going to see both federal and state activity, and I think this is an appropriate place for government to kind of lean into, where it's like, okay, if you're not going to do the big appropriations, at least clean up the data so everybody else could do the work they need to do and could do it with good information. So excited to get to work on that. I can get more in the details and weeds. I'm not sure this is the audience for that. But if you do want to kind of learn more about what it would take to kind of promote this level of data standardization, we have a few different initiatives that are just focusing on those things. I'd be happy to share more with you.
Well,
I just add a little bit just on that. Jason mentioned Medicaid and the requirements there. That's kind of the stick, but there's also a carrot here for states, which is Workforce Pell, where Workforce Pell, in order to implement it, in order for states to actually, students in their states to actually be able to receive Workforce Pell funding, the state needs to get to improve their data systems. That's both in the near term, but also then by year, it's either 3 or year 4, they actually need to also be tracking occupation data, which right now I believe only 2 states do, because they need to see when a student goes into a Workforce Pell training program, and then they graduate, are they in, as part of the placement metric, it says, are you in a relevant occupation? So they need to know the occupation of everyone who's being tracked to be able to then know whether they're actually in a relevant occupation. So there's both, I would say, Medicaid work requirements, but then also, and the other work, SNAP work requirements too, but also in addition to that, Workforce Pell. And I know that a number of states are seeing those things as the same in the sense, and they're proposing legislation that would basically accomplish both. It's just kind of like both of these things, the stick and the carrot. It's pushing states to do what they have been doing very slowly for a long time, which is creating state longitudinal data systems that are tracking people, sometimes from cradle to career. And that's really exciting and something that's relatively new.
Just to quickly point out again, follow the money. So you got WIOA, where you're about, $4 to $5 billion. Then you got Pell, which is between 20 to 30 billion, depending what year you're in. Workforce Pell remains to be seen. Medicaid, $1 trillion.
Yeah.
So I'm like, let's make sure that they pay for it, they solve it, but that everyone else has access to the data to do what they need to do. So that last point Ethan made is really important, because the worst case scenario is we build 53 different systems for collecting this data for Medicaid, and only Medicaid gets to use it, and they don't share data with anyone else. That would be a disaster. But I wouldn't be surprised either, because we've done it before. But again, this is where I think this is where we're spending a lot of time at the Chamber and Chamber Foundation, is making sure this coordination's happening and everyone kind of knows each other's role and everyone kind of gets outside of their silo a little bit to say, this is one data solution that everybody could benefit from. Let's not create a silo.
Well, I appreciate the optimism. I profoundly hope that when we come back and do this panel in 10 years, maybe we won't need to be complaining about bad data quality anymore, inhibiting our ability to know what's working or to scale things. Like, truly, that would be a great outcome for all. So shifting gears a little bit, Ethan kicked us off on starting to talk about states. Harry and David, one question I had when I was reading the paper is like, so if I was advising a governor today, governor's interested, this seems, we need, as we've discussed earlier, we need more capital to support workforce training. I'd like to be doing more in the job training space outside of the traditional 4-year degree. how can I find creative ways to finance that? And they're looking at outcomes-based refinancing as a potential option. From your big review now of the literature and what's out there, kind of like, where would you point them? Where should they look? Is there an existing state program that you've seen with public finance or public-private financing that you would say this has the kind of building blocks of what you should look at, or is it a kind of collection of different models that are included in the paper?
I'm going to defer mostly to my colleagues up here. I think we've looked more carefully at these. But when David and I were going through these programs, different states, and again, along the lines of one size will not fit all, we're both from New Jersey, right? which we're willing to admit publicly. And New Jersey has a pay-it-forward model that I think has a lot of appealing features that does bring in new money, new public money. At the other end, we talked to a few program operators from South Carolina, like South Carolina Bold, which really was not a public-funded model, and yet still seemed to, where the state plays almost more of a coordinating kind of role, which might well work in certain environments in certain states. So just to indicate to the breadth of the possibilities and the fact that both very blue and very red states could find something that works in this, I think, broad landscape.
Yeah, I think what I would say is it really does depend on the population you're serving. Mm-hmm. It depends on the occupation that you're aiming at filling. And I think that these programs, Harry just said, not one size fits all. The right thing to do is to build a program that has certain key elements that work for that population. If you are serving populations with greater barriers to employment, wraparound services are an evidence-based, clearly valuable, helping people have some supports and help and some money while they're in training so they can pay rent and eat and get transportation and other basic needs because tuition, as Harry said in his opening comments, tuition is not the whole picture. If those are your key populations, you're going to need to figure out how you're financing that. One of the things that we have seen that is really promising is using these mechanisms to finance those other costs and blending it together with other money that the government is already spending. So if a state has an initiative that's a grant for training, some states have tuition-free programs of various kinds, shorter-term training like they have in Virginia, but people don't have the wraparound services with those programs. You could finance that through something like this. I think that if you're aiming at something where you're going to have the employer repaying, you really want one of the efforts where you're doing the matching, the direct matching. The South Carolina program that Harry just mentioned, you don't get into the loan until you have essentially a tentative job offer from an employer. Mm-hmm. So that is essentially the match done up front with the understanding that the employer is going to repay if you work out as an employee. And if you don't, there's the downside risk protection. But there's a pretty good sense that it's going to work out. So wraparound services, figuring out what the employer demand is, and then the data piece. Mm-hmm. What I would say to states is, rather than create all of the complexity of the collections, even with the imperfect labor market information that they have, if they can be sharing with the program operator the unemployment insurance tax records that tell you within 3 months how much someone is earning every 3 months in their state, it's not perfect, but it's a lot of information that makes it much easier to then establish the calculation, how much has to be repaid under that obligation, and then make it easier to do the collections, the servicing of the loans, and streamline the program so it can scale.
I just want to dig a little deeper on this. I'm someone who's been of the view that the eligibility requirements in WIOA, for instance, become administratively complex, have also made job training potentially be viewed as a thing over here for disadvantaged workers that's not for everyone. I think we're in a moment potentially where we may need a lot of folks who don't fit our traditional definition of disadvantage might be looking to pursue short-term training. So am I hearing your advice right, though, that like a governor should think about setting up different types of programs for different populations? Or is there a world where we have a big program and you can, I don't know, if you need additional services, there's ways for you to access them, but it's not necessarily like I can only participate because of the characteristics of who I am as a worker?
Yeah, I think that you have to have market segments. I think the reality is the terms of any loan are just much different for someone to comply with or to understand, right? And so there does need to be more done to explain these programs. But I think you're absolutely right. We're going to have dislocated workers who perhaps look a little bit more like the workers dislocated by global trade a few decades ago, that there were, different initiatives for them. I think that having a more holistic offer that has terms that vary based on how much is the expected earnings. I mean, when you're placing someone in a job earning $40,000, that's really quite different from placing in a job that earns $80,000. And we have training, really good medium to short-term, non-degree training programs that can get people both of those kinds of jobs. I think you're going to need different loan terms for those different types of jobs.
So I do want to leave time to open it up for the audience. I'm going to ask one more question, and then we'll get your questions ready. I'm excited to hear from you all. Ethan, another kind of timely aspect of this, we have seen some recent changes to overall student financing under the Big Beautiful Bill. I'm curious we'll go through the whole panel of thoughts for the entirety of the higher ed sector right now on what can be learned from this particular space. Are there lessons that apply more broadly beyond just the traditional types of short-term workforce training that we've been talking about that are helpful to keep in mind, and where the field should be moving from here?
Yeah, absolutely. So in the One Big Beautiful Bill, it applies loan limits both on Parent Plus and then eliminates Grad Plus, which means that both for undergrads and graduate students, they no longer can borrow up to the cost of attendance entirely federal loans, and now will need to go into the private market to fully finance their education. And that creates some risk. The private student loans, for those of you that have or may still have them, are oftentimes have worse contract terms. They tend to have discriminatory interest rates where your interest can depend on your credit score. As well as then, you might just not even be able to get credit, get a loan if you don't have good credit, or maybe you have bad credit, or if you don't have a cosigner. And then on the repayment side, these loans tend to be fixed payment, which means that if there's a recession or you lose your job or something, you still have to make those payments. And so these are very inflexible, oftentimes inaccessible and unaffordable products. And the product that we're talking about here, an outcomes-based financing mechanism in which repayments are based off of the earnings that the student has after they graduate, feels like that can be a much better option. And we've talked mainly about kind of some of the programs that have happened in the workforce space, but in the higher ed space, there was a very big one. Purdue University back in 2016 launched an income share agreement program that ran from 2017 through 2022. And it was actually, it was somewhat controversial when it was launched. We have recently done some research on it. It was published last summer that found that it actually seems like it was fairly successful at providing a more affordable and more accessible option compared to the Parent Plus option, was kind of the comparable fixed payment loan that was currently in the market. And so we're going to be continuing to do some more research with Purdue on this, but it's enough there where it feels like this is a approach that not only can exist in the workforce space, but can directly address some of the challenges and some of the risks that students are going to be facing in the higher ed space as well.
I got to apologize. I got to run. Thank you all. Thank you.
Well, a good timing as well. I think before we move to the panel, I want to see David and Jason, anything that you would add on sort of lessons for the big kind of higher ed in this moment, and what we should take from this paper, and more broadly, what's been learned about outcomes-based financing from these job training programs.
You want to go first?
Yeah.
Okay. So, just in reaction a little bit to what Ethan was saying, pointing to kind of like, look at the one big beautiful bill, and he's kind of pointing to kind of the potential downside impact of going to private sector. I actually look at it as I'll pull a 180 and be like, it's almost a corrective measure, because there's theories of market failure, and I say there's theories of government failure, and we're kind of dealing with the consequences because it was not exactly working out too well in some of these program areas. So I think some of this is just a correction that's being made, and time will tell where things go. But I think in the immediate future, higher ed does need to pivot, because the pie's not getting any bigger. So if you're going to try to find net new dollars, you're going to have to get creative, which means work partnerships with the private sector, potentially tapping into new innovations, like if these skill savings accounts work, and that's a net new $50 to $100 billion, how are you going to get some of that? But it's not going to be funding the same kind of programs that you're accustomed to under the old finance regime. So things are going to have to change. Change is hard. It requires change management. But I think this is just a corrective action that's happening. And we'll have to see where things go. But if you're going to be operating as kind of just business as usual, you're going to get a smaller piece of the pie most likely. And what I would kind of point to is kind of like thinking like, where is this all potentially going? In my mind, I can see us. We talked a lot about improving. We improve the policy, improve the regs, improve the appropriations, improve the data. But the technology is something else entirely. And I'm really excited about where the fintech might take us. And I could see a future where there's an individual who has an account called a skill savings account or something else, and they're getting employer contributions tax-free. They're able to put money in as well. They've been deemed eligible based upon their income for an ITA, which could be directly deposited in that account. And now I'm seeing I got 4 or 5 different pots of fund that make up this account, and they could be used in a combined way with certain providers or have to be segmented otherwise. And now I can share that information with the market, so David could find me and say, hey, I know how to close that last mile funding that you need with an outcome-based product, and you could essentially get your education for free now, and your employer could pay it back. But it's like, cut the middleman out, let an individual interface with the technology, get them money faster, and then give them powerful services to find the right kinds of providers who could help close those gaps for them. We'll see if we get there, but I think that is a future worth looking forward to.
Really interesting.
Well, that's a very exciting future, but for right now, we do have these institutions. And so we've talked about employers, we've talked about workers, and we've talked about the government. But, training providers, that is to say institutions, and when you talk about traditional higher ed, they have not, Purdue notwithstanding, generally been innovating in offering their own loans, offering a financing product for their main service, which is providing education and training, to say we will stand behind it. We will put some skin in the game. We will take some risk off of our students and off of those students' future employers. And so I think tripartite models, or with more, if there's government funding as well, 4-way models, where there's employers, employees, government, but the training provider themselves really playing an innovative role. When they're seeing their demand dry up, or when they're seeing people come to their institutions saying, I used to be able to finance this with one of those federal student loans, and now there's a cap and I can't get one, or I can't get all of it paid for, maybe fill that gap with a model using outcomes-based repayment.
And there are already some institutions that are doing this beyond, Washington University in St. Louis, University of Kansas School of Law recently announced, I think last month, that they're both launching institutional loan programs to serve their students. One, maybe both, is leveraging endowment dollars too. which is, I think, a really interesting approach because it's so difficult. These are very capital-intensive programs to get started. You have to put the cash out now. Repayment comes very delayed. So leveraging the endowment is really exciting. And then in Connecticut, there's legislation that the governor's endorsed. It's moving its way through the legislature to create also a loan program as well. These tend to be, though, fixed payment loan programs, so you still have the question around will they actually be affordable, or are we just recreating the same unaffordable approach in kind of more traditional private loans. I think it's still better in the sense that you're getting, certainly on the grad side, a little bit of risk sharing. The school is still putting putting their skin in the game. But at the same time, I still would hope that they start embracing more of an outcomes-based approach that we're talking about here.
Yeah, super fascinating. Interesting to think about this paper in the context of a broader kind of moment of what does higher ed owe its students, and what role should it play in taking on some piece of the risk about whether your program delivers on the value that we were promised. All right, so with that, happy to open it up for questions. We have a few minutes. Yeah, it looks like we already got our first. If you could introduce yourself, that would be great.
Yeah, good afternoon. Todd Wiggins here, a video production specialist here in DC. My question has to do with the upcoming potential passage of the Clarity Act. I'm sure you guys are familiar with that, especially the fintech side of you may know a little bit about the crypto industry, and if you think that might play into any of this as far as financing in a legitimate fashion in the next couple of years.
Yeah, I'm not authorized to speak on that from the Chamber or Chamber Foundation, but I do think it's fascinating. And I don't think we have I'm not familiar with the position that we might have on it just yet, but I think that's one of those things. If you're looking at like, how do we get outside the box? How do we get creative? Could crypto be leveraged in some way to maybe deal with some of these challenges? I would see it as a conversation worth having, not one to necessarily just run away from because it's got crypto in the name. So I'm intrigued by it, but can't say that I have a position or a prediction on where that's going to go.
Yeah, Ashley.
Hi, guys. Ashley Putnam, Federal Reserve Bank of Philadelphia. I guess my views are mine alone. I should say that today and do not represent the Federal Reserve. I'm actually going to ask a question about data. I usually ask you about employer partnerships, but I was thinking a little bit about this question of data. And the other part of this market failure is that we're asking young adults to navigate a system where they have no information on whether or not there's a return on their investment. And if you want to see an example of that, look no further than like ITA vouchers, which is a huge part of the WIOA funding. I'm thinking a bit about employer engagement and feedback loops. How do we make sure that that data is getting into the hands, right? We make decisions about consumer choices, and yet consumers don't have the full information or picture on whether or not this particular certificate program is actually getting me any sort of results. And yes, I am kind of interested in this because we would love to study it. But I'm curious, when you think about that data question, I hear a lot of us talking from, systems and policy side. How do we think about that data question in terms of just the user, and are we actually getting users' feedback on what is actually worth investing their time and energy into?
Well, it's a terrific question, Ashley, and one of the things we call for is what a state government role is, what a federal government role could be, and very much, college scorecard exists to the extent that it's giving information on degree programs, but on workforce training programs that are not degrees, there is no equivalent. And states are beginning to work on this. Some of them have dashboards and other forms of consumer information. Whether consumers find that information is a different question. But I think these programs actually offer quicker feedback, right? Because if you've got people who took a training program and finished it 3 months ago and they haven't made payments at the percentage that you would have expected, you have immediate feedback. You don't need to wait, for 4 quarters after exit to find out that that program didn't get people jobs that pay well enough to owe an repayment obligation. Maybe there's something there. It certainly could be information that a state could require to be reported and then put up on some kind of consumer information portal.
I'll just quickly add on that. For anyone who's going to be designing these policies in the future, though, like not just thinking about what's going to be reported, but then thinking about the second part of what you said, which is how is it going to be displayed to the consumer? Because unfortunately, I think we often miss that part, and we take compliance metrics and try to put them out in a totally indiscernible way for people. We haven't
Context-free. Yeah.
Huh?
Context-free.
Totally, and not an easy to digest, or don't answer the questions that someone needs to know before they actually pick a program. I think there's a lot of space for more policy implementation focus, and when we're writing new state legislation as well, to really put that kind of consumer's lens at the center, instead of just thinking about, well, what information is the bureaucrat going to need to ensure that the money is being spent in the way that it was authorized. Because those two things are not the same, and I've seen it over and over again.
Just to add to that about kind of like how do we get it to the consumers where they're at, I think this goes to one of Jason's proposals around a skill savings account or lifelong learning account, in that if you are creating a technology that has a very friendly user interface, and that's where the money is coming in, that's where maybe the choices are, you have the ability as the government to also be, if this is a government product, you have the ability to also then be curating data in a way where they can then navigate. You already kind of have their attention there. And so you have kind of a single portal in which you can kind of then be thoughtful about how to present that data and ensure that their decisions are informed.
Just to jump in on this one, there's a couple of missing signals here that I think are really important. And you're right, Rachel. I would argue that the old data paradigm we operate in, it's data is collected, it's by government for government, and it goes like policymakers, researchers, and managers. Mm-hmm. And even they would make claims of like, oh, this is for evidence-based policymaking, and yet I see so very little of it. Like we're not very good users of the data, and the data is not very good. But we're using it to make like high-stakes decisions, where now you're starting to see these kinds of policies like down in Texas where programs and credentials are in and out based upon what the data shows. Yeah. And that's interesting, but the consumer information piece, what I've long been trying to solve for is the employer signal of quality. Because if you were to ask what does business community think's quality, there's no signal out there. We've played with it in our talent supply chain systems with preferred provider designations, but I think that's an area that can scale, and we have some ideas of how to do it, and maybe Workforce Pell is the place to start, where you can at least see which employers have actually signaled that this is a program they would hire somebody from. So I think that could be systematized and scaled and enabled through technology. Got some ideas there. The other piece is peer-to-peer signaling. So bringing back like the skill savings account idea, and I would actually hope they're private sector products, not government-run ones, but they can still host the data. But as we think about that deployment, now imagine if I'm going in there and I'm looking up programs that I might want to spend these dollars on, and one of the things I'm seeing is a rating system like you would find in any other consumer information platform, where now I'm seeing, well, people that have an account like mine, who are in or maybe outside of my state, have seemed to be ranking this one very strongly and this one very poorly. That might make a decision on whether I click the button next to learn more or to enroll or purchase. So I think that's an important signal that we got nothing for that. Mm-hmm. But again, I think technology could help us better connect and signal one another. So yes, we need it for the managers to make the high stakes decisions, but we just need regular people and companies figuring out like, okay, well, if I see these companies have signed off on this program, those are my peers, I'm interested. Or if I'm a worker and I see this one's consistently getting 5-star reviews and this other one's getting 3, right, that tells me something.
Yeah, it's a great point. I think we have time at least for one more, maybe 2. Yeah.
Hi.
It's on.
Hi, I'm Megan Hezzy from Scholarship America. So I have a question that touches both on the wraparound services comment and then the comment on smarter tax policy. So we administer the scholarships for about half of the Fortune 500 companies, and we've seen a growing number of them also bolt on an emergency aid component of that. So small one-time payments, usually up to $1,000 for students who might be dropping out over something like a flat tire because they physically can't get to their training program. But in terms of the tax code, we see also a lot of questions and a lot of reluctance sometimes from businesses who want to spin up those kinds of programs or have their scholarships cover additional living costs because they don't fall under Section 117's qualified scholarship educational expenses. So I was wondering, in terms of kind of this move towards more workforce training and kind of the evolution of this and moving away from kind of the degree for all piece, if you think there's room also for some reform around that type of Section 117 and being able to make it more attractive for employers or other people who might want to open up these kinds of funding opportunities to cover additional needs that students have around basic needs and cost of attendance.
Jason?
Yeah, it's a tough one because, like, even as we were developing the policy and the draft bill for skill savings accounts, which hopefully will be introduced soon, that was one of the questions we had to take on. Is like, where do you draw the line in terms of what's allowable? And what we ended up doing is just adhering to the current Section 127 of the tax code. We want to bifurcate it to Part A and Part B. So in some ways, we kicked the can on. Just said it's going to play by the same rules because if we're comfortable with it there, let's just extend the same treatment you've been doing. We don't need to kind of resell you on something. But like that issue kept coming up of like, wouldn't it be nice if you could spend on all these other things? And I think the concern we had was the more you're getting away from kind of the core mission, the more at risk it is of being criticized as being an end around for some other purpose. And it makes me think that, can you have it both ways? And maybe it's not trying to kind of say the money could be used broadly as much as I'm curious of the example you just provided of like, there's kind of like an auto payment or something. I forgot how you described it exactly, but I'd love to learn more about it afterwards. But if there's some way to kind of pair investments in skill savings with an emergency saving account, and they can be treated differently, but from a user interface, it all seems like it's one place, and it's just a different pocket of money that can be used for a different purpose. Like, let the tech help me manage my money. And I think the back end infrastructure can be put in place and enabled through that technology and could be simplified. So like we know money coming for different purposes, for different uses, and the tech's going to prevent me from using it in a way I shouldn't. So I'd love to play with that more, but I think if that's it would be an interesting way to sell it, where maybe it's don't like, so if this happens and the U.S. Chamber gets out there in a big way to say, hey, let's open as many of these accounts as we can and get those first dollars in, we could do that, or we could say, and add an emergency savings account on top of it for these exact scenarios. That's something we haven't talked about yet.
So I know we have one, it'll be very quick. We can do one final question.
Thank you. Thank you so much. Can you hear me? I'm Tanya Garcia, and I'm with the Institute for College Access and Success. So I've heard a lot during your comments about the employer and the level of risk that they're taking. And, the risk is, when I think about the risk is the human being that they are wanting to invest in or not. And so I am really hoping that I'm hoping that employers are going to experience a shift in mindset in terms of how investing in their workers and improving job quality is really the dominant way of approaching how we increase social and economic mobility. And so all of the generational shifts in the workforce are going to matter a lot to the younger generations that have different expectations when it comes to working and learning. And so I'm curious whether any of you have key employers in mind where this mind shift towards job quality and towards investing in individual is already playing out.
I'll just say we have, through our talent pipeline management, that's the talent supply chain work, we have an entire set of curriculum just on designing for job quality. And we could show you the chambers and the companies that have been part of that. So it's definitely there. I think for a lot of things, we think like employers just know this stuff and choose not to do it. like they're just really busy, and they don't. And for a lot of small to mid-sized companies, they don't even have an HR department. So they're trying to just get by, and they're trying to survive in a very dynamic market. And what we have found really helps is if you just organize the information in a way that they can receive it well, and then build their capacity to make good choices as a company and make flexible choices around. For job quality, we have a whole many different toggles you can use. It's not all about just like the money. It's about the hours, it's the scheduling, it's the other things. So it's the benefits. And we say try to figure out what's the right combination of job quality features to get you where you're trying to be, and let's help you even understand where you're trying to be. Because for a lot of them, they just haven't had the space and time to sit and come up with a plan. So we've often found training up these, whether it's chambers or other intermediaries to go and provide that service to them, it goes a long way. But if you're trying to get some immediate examples, we could probably pull some of the folks that have gone through that experience and connect it to them.
Well, I know probably some folks in here have to get to class, so I'm always cognizant of that. Let me thank Social Finance Institute and Georgetown McCourt for pulling us together today and hosting this wonderful conversation. And thank you to my panelists for all of the great insights.